So let's get right into a real puzzle that's going on in the markets. We've got soaring inflation. We've got global conflict. I mean, gold should be flying high, right? But it's not. In fact, it's crashing. So what is really going on here? Let's break it down. If you're watching the news, you're probably hearing that the gold rally is over, that it's dead in the water. But you got to ask yourself, in a world this unstable, does that really add up? Why would the ultimate safe haven asset suddenly take a nosedive? That's the question we're digging into today. And this slide, well, it lays out the problem perfectly. On the one hand, you have all the reasons gold should be doing great. And on the other, you have what the market is actually doing. It's this total disconnect that's at the heart of our story. So here's our game plan for getting to the bottom of this. We're going to start with what the mainstream is saying, then we'll peel back the curtain on Wall Street's mechanical selling. We'll look at the paper price versus what's happening with physical demand, explore these two totally separate gold markets, and then wrap it all up with some long-term perspective. Okay, first up, the official story. This is what you're probably going to hear on financial news channels about why gold's suddenly on the outs. The argument you'll hear everywhere goes something like this. Inflation is being really stubborn, which means the Fed has to keep interest rates higher for longer. And when interest rates are high, US dollar gets stronger. A strong dollar makes an asset like gold, which doesn't pay you any interest, look a lot less attractive. That's the official narrative, anyway. But what if that's not the whole story? According to our source, this isn't about the big economic picture at all. Nope. This is about the market's internal plumbing, a really violent mechanical reset that's happening completely behind the scenes. And here's the theory, and it's a pretty cynical one. The claim is that this isn't some random market move. It's a strategic liquidity flush, and it's supposedly designed to absolutely crush the smaller retail investors who jumped in late, often using a ton of borrowed money. Now, to really get what's happening, you need to know about a specific kind of player on Wall Street: systematic hedge funds. Look, these aren't rooms full of people making gut calls. These are powerful computer algorithms just running code. They automatically buy and sell based on preset rules. They don't care about inflation or geopolitics. They just follow the model. So, how did this whole spiral kick off? It was like a chain reaction. First, a spike in oil prices gave bond yields a little push upwards. That was the trigger. The second those yields moved, the algorithms at these big hedge funds just sold automatically. They flooded the market with tens of thousands of paper gold contracts, which slammed the price down. And that price drop, it triggered margin calls for all those smaller, leveraged investors, forcing them to sell too. It's a pretty brutal, self-fulfilling prophecy. But here's where it gets really, really interesting. While all this chaos is erupting in the paper market, the world of contracts and derivatives, the market for actual physical gold is telling a totally different story. Get this. While the paper price was getting hammered, the world's central banks were doing the exact opposite. They were on a massive shopping spree, buying a staggering 863 tons of physical gold last year alone. The biggest players in the world are quietly stocking up. So why are they doing it? Well, according to the source, countries like China and Poland are aggressively hoarding real, physical bullion. They see the suppressed paper price not as a weakness, but as a golden opportunity, a chance to buy the real thing at a steep discount. All this massive demand for physical gold is having a huge physical consequence, something our source calls the Great Vault Drain. The actual tangible metal is literally walking out of Western bank vaults. And the numbers here are just wow. The amount of physical gold that's actually available for delivery on the COMEX exchange, it has collapsed by 31% in less than a year. The physical supply is just being drained away at an incredible pace. You can really see it on this chart. Look at last April. There were over 24 million ounces of registered gold. Now look at today. That number has plunged to under 17 million. It's clear that as more and more people demand the real thing, the physical metal is leaving the building. So this all leads to a massive risk, what's called a failure to deliver. I mean, think about it. If there's a big shock to the system and everyone demands their physical metal at once, the exchange might not have enough to cover all those paper claims. And in that scenario, they'd be forced to settle with cash, with depreciating dollars, while they get to keep the actual hard asset. Our source calls this, allegedly, a wealth extraction machine. All right, so you might be wondering, is this brand new or is this just history repeating itself? Well, let's take a look at the historical precedent here. Our source points right back to 2008. Remember the financial crisis? It was pretty much the same playbook. A huge crisis hits, institutions are desperate for cash, so what do? They dump their paper gold, causing the price to crash. But what happened right after that flush? Gold took off on a multi-year bull run to record highs. The pattern is strikingly similar. So here's the bottom line from our source. What we're seeing today isn't some fundamental verdict on the value of gold. It's not the world deciding gold is worthless. No. Instead, it's a violent mechanical reset of a trade that just got way too crowded with people using way too much leverage. So what's the big takeaway from all this? According to our source, the strategy is pretty simple. Just avoid the leverage traps set by Wall Street. Instead, they say, focus on physical, hard assets, stuff you can actually hold in your hands, and just ignore the wild noise of the paper markets. And that really leaves us with one big question to chew on. In a financial system that's built on these incredibly complex paper contracts and derivatives, what is it that holds real, tangible value at the end of the day? It's definitely something to think about. Thanks for tuning in.